Hey, everybody. Happy Friday to you. My name is Brent Moore. It's time for Condors, Calendars, and Butterflies. Today, we're going to be talking about iron condors, everybody. So buckle up. I think it's an important strategy for people to know. It's kind of a foundational strategy for these multi-leg option strategies, some of these more complex trades. Well, you got to have a starting point, and I think there's no better starting point for these than iron condors. I'm glad you're here. We have some new people here today, and we're grateful for that. And if you're an old timer, so to speak, we're glad to have you as well. And if you're watching on a recording, that's great. I'm joined by James Boyd in the chat. I appreciate James. James teaches multiple classes throughout the week, including an Investor Masters series I encourage you to check out. That's at 11 o'clock on Tuesdays. But let me just mention this with iron condors, which is what we're going to be talking about. And that is, I'm going to assume today, I'm trying to make this more of an introduction, but I am assuming a little bit of options knowledge here on your part. But I don't understand a deep understanding of them either. But if you're more of a beginner, I encourage you to stick around. This could be your starting point. And if you're a little more advanced, I think there's still some things you can pick up on. Now, I need to talk about a few disclosures as we get into this. Also, a reminder, you can follow me or James on X at Brent Moore CS, at James Boyd CS. Remember, options do carry a high level of risk and are not suitable for all investors. And this material today is intended for general, informational, and educational purposes only. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. The paper money application, which is what we're going to be using today, is provided for educational purposes only. Now, there are some differences between paper money and the live platform. One of those differences is short options aren't assigned early in paper money, but they can be in your real platform. And let's see, all investing involves risk, including loss of principal. There's no guarantee of an execution of a stop order, that it will be at or near the stop price. I'm going to go through symbols today. We'll look at trades. They're not recommendations. They're examples. Past performance is no guarantee of future results, and Schwab does not recommend the use of technical analysis as the sole means of investment research. Let's head on over to the Think or Swim desktop software. And this is the market right now. I mean, we had a big jump. You guys are all aware of this. You've probably heard it a bunch. A lot of volatility in the market. And so, in this market, in any market, there are bullish trades, there are bearish trades. And one of the nice things about options is this: they give you the ability to trade in different market conditions. Okay. Most of you, I think, are probably familiar with trading in a bullish market. I mean, maybe it's just buying a stock. You buy a stock, you expect it to go up. You want the stock to go up. A smaller portion of you have thought of, well, what if I can take advantage of a stock going down? And some people will use other strategies that I'm not going to discuss today, but like shorting stock or something is just a bearish strategy. That kind of opens up the playbook, so to speak, a little bit. But there's some downsides of those strategies. For example, with the shorting stock strategy, there's a theoretical unlimited risk on those strategies. That's the last I'm going to say of that today. But one of the great things about options, there's pros and cons. One of the great things about options, though, is that you can do other strategies like neutral strategies. And that's what we're going to be talking about today. We're talking about neutral strategies today. Now, if you may have a concern, an objection, and that objection may be, hey, the market's kind of crazy right now, Brent. It's going way up, or it's been going way down and just jumped way up, and it's very volatile. How could I do a neutral type strategy? One thing to remember here is this: when you're doing options, you are compensated more. You're bringing more premium if you're an option seller, if the market and implied volatilities are higher, to try and compensate you for the risk in a sense. Now, if you're an options buyer, which is not really what we're talking about so much today, you actually have to pay a little bit more for options because of the increased potential of that stock underlying stock going up or down. But in this case, this is just a chart of the VIX, which is just a measure of implied volatility, just a measure of how expensive options are. Now it's come down a ways, but if I go back to say a 3-year chart, you can see this is where we are right now. Let's see if I can mark that so you can see it a little better. This is where we are right now on this, okay? But most, if I were to extend my hand's probably not steady enough to extend that line all the way over exactly. But most of the time, implied volatilities have been less than this, meaning we've been compensated less to do these short options that we're going to be talking about today. So don't let that be the only impediment. Now, you still have to find a stock that you are comfortable with in terms of it's a neutral stock. That's what we're going to be looking for. And so, but let's talk about what an iron condor strategy is here. Let's take an example. Let's say you have a stock that you think is going to be kind of neutral. This red line represents the stock right now. There's the stock, and we say, well, I think it's, these kind of a support or resistance, and I think it's going to stay kind of in this channel. And so you may decide, well, look, I've got kind of a resistance up here. I've got a support down here. I think the stock is going to stay in that range, more or less at least. And so what do I do? Well, one option strategy you can do is you can sell a call, and we'll sell a call at a higher price. And if we sell that call, basically we bring in money, we bring in a premium, and we just say we don't want the stock to go above that price. It's kind of a simplistic way of looking at that. And but then the objection comes, well, yeah, but what if it goes above that? And then there's this very large potential risk, theoretically unlimited risk. So we're going to limit the risk, and we're going to buy a call. See if I can write this out. Sorry about that. My penmanship isn't very good. We're going to buy a call at a higher price. That's called a long call. A long call, or buying a call at a higher price. That's going to limit our risk. Still, the objective of that trade, and that trade right there, is called a short call vertical spread or a bear call spread. The objective of that trade is for the stock to stay below where that short call is, right there. Okay. Now, we can do the same thing on the other side. We could sell a put down here, and we could say, hey, I'm bullish. We bring in a premium. We bring in a premium on the call side of things. We bring in a premium on the put side of things. That's great. And we just want the stock, in the case of the call, to stay below the short call. In the case of the put, we want it to stay above the short put. And to protect ourselves on that downside, we're going to buy a put below that in case the stock were to just completely crash or something like that. And so that's the strategy. This is a short put vertical on the bottom side. So now you're going, Brent, this is supposed to be about iron condors. You're not talking about iron condors. You're talking about short call verticals and short put verticals. You know what? When you do these two together, they're an iron condor. Now, let me just pause here 1 sec. We have a workshop and a workshop from Dallas joining us right now. And we appreciate you, all of you in the Lone Star State. Welcome. Thanks for jumping in. We're just talking about iron condors here today, but you know what? You're in great hands with Ben and the crew. I think Kevin is out there as well, I know, probably Scott Durfee and Ray, I'm guessing. Welcome to all you. Glad you're here. Now let's get back to iron condors here, everybody. So if you do that short call vertical and you do that short put vertical, and then they're on at the same time, that is an iron condor. That is an iron condor, everybody, okay? Now, do you have to enter them both at the exact same time? No. Some people will kind of leg into an iron condor. They'll do a short put vertical, and then they'll do a short call vertical after, and they end up with an iron condor. But it is a neutral trade. We want the stack to stay between those two levels. We bring in those premiums on both sides. We want the stock to stay in the middle. Now, how are we going to know if the stock is going to stay in the middle? We don't know. Of course, we never know. Some traders will use support and resistance lines like I suggested. Some traders will use what we call probability analysis. And I'm going to show you that as well. And nothing is guaranteed as to what it's going to be. And these probabilities, if we talk about probabilities, are going to be estimates. They're just not a guarantee. All right. So that's what an iron condor looks like. Now, let's go ahead. Let me get out of this and let's talk a little bit about what an iron condor is here. All right. So what are the basics of this in a little bit more detail? And then I want to look at specific examples of this trade here. And by the way, and let me just mention this because there's great questions. Kelly in the chat said, Kelly kind of leans into not like entering both at the same time, legging in, like I mentioned. In other words, maybe the stock's kind of near the resistance and maybe perhaps even bouncing off that resistance, legging, doing the short call vertical first, and then later doing the short put vertical. There's no one right way to do it. I may not have time to show you all these variations today, but just realize there's nothing wrong with legging in or getting in at different times or putting them not equally spaced. Maybe that short call vertical is a lot closer to the current price than the short put vertical that you use. You can do that too. That'll make it a little less bullish or bearish. You can make it a little bit more of a bullish or bearish trade. I may have said that wrong. A little less of a neutral trade if you put them that strikes closer to one side or the other. You can directionalize the trade a little bit there. All right. Now, let's just talk about, I want to talk about a few things that I'm going to be real quick here, just for those of you who like a summary here on this. I'm going to bring this down so I have it on one page here. Iron condors. I'm going to abbreviate here. I'm just going to say short call vertical plus a short put vertical. That's what they are. And very often, and the way I'm going to teach it today for the most part is I'm going to say we're going to do these 20 to 40 days till expiration. All right. Now, if you're taking notes and I'm doing this abbreviation DTA and you're not going to realize what DTE means later, you may just want to write down in your notes next to DTE what that means. That's not how everybody does it. That's how we're going to do it in this particular webcast here. Okay. We're going to call these non-directional. As I just mentioned, you can make them a little bit more directional depending on what strike prices you choose. But that's, we're going to generally call this kind of a more neutral or non-directional trade. Now, if you're new to options, you may not be familiar with what I'm about to write. Positive theta and negative vega. All that means is this. Positive theta means everything else being equal, each day that passes, it benefits your trade. Now, it may not make up for a large stock movement, but it does benefit your trade, time decay. That's what theta is, time decay. Negative vega means if implied volatility settle down, the markets get a little less crazy, that's going to tend to help the trade a little bit. If the markets get more volatile, there's more expectation of volatility, it's going to work against you. It's going to work against that trade. That's what those mean there, okay? Your max gain on the trade is limited to the premium you receive. Now, I mentioned earlier, you receive a premium both from the call side, the short call vertical, and the put side. So you receive that premium there. Your max loss, and you don't have to remember all this exactly, is the difference between the strikes. And you can just look, if they're equal distance, the call side and the put side, you can just look at one of those sides minus the premium. Typically, when we're doing these, what we're going to see is your actual max loss is larger. Your max loss is larger than your max gain. Now, it all depends on the strikes you choose, but the benefit is If you do it a certain way, you can also make it a higher probability trade where you win more often than you lose. And we'll look at that a little bit more as well. Okay. And so, the break-even points are the short put strike minus the premium, and the short call strike, that's the one you sell, that's going to be above the current price plus the premium. So in other words, if you're looking at the stock and you see and you're looking at the strike prices and you want to know where does the stock need to be in order to be at a profitable situation, we want it to be above the short put strike minus the premium or below the short call strike minus the plus the premium. Now, if you're new to options and this is going a little fast, you don't need to worry about that right now. That's kind of details for more advanced folks. But just remember that the probability and the reward or the risk depends on your strike prices. Okay, I've got a couple more there. Okay, and I'll get your questions answered there, Trevor, as well. The way we're going to do it is we're going to look for a probability. So this is getting that probability analysis I mentioned earlier. We're going to judge that probability of the in the money the short, we'll just say the short strikes around a 20 delta. And if we keep our short strikes around a 20 delta, both on the call side and on the put side, that should give us a higher probability trade. In other words, more than likely this trade, if we just let it run to expiration, should work out. There's no guarantees with the probability, though. It's just estimations. But that's how we're going to do it in this webcast. You can increase the probabilities of the trade, but your reward to risk ratio will suffer. Similarly, you can make the trade a little less probability, but improve your reward to risk ratio there. Now, question from Trevor said, so do I close all the positions at the same time, or do you pick and choose? You can pick and choose. In fact, typically, we're not going to get out of every position at the same time. So we're going to exit one side at a time. And I'm just going to write typically with that. And we'll talk a little bit more exits here in just a little bit as we do that there. And one other thing we're going to do is we're going to exit if less than 10 days till expiration. I think I have one more thing here. And let me just say, for money management, manage 1 to 2% of active portfolio risk. Okay? All right. So that's how much money we'd be willing to risk on that. There's your basic rules. We're going to go into these in a little bit more detail here in a little bit. Now, some of you like to take screenshots or something like that. You can take a screenshot of that right now if you want. But before I do so, let's go and talk about how do we find these trades? Because there's different ways to find a trade. And so let me move this over here and let's talk about some of those ways to find a trade. First of all, anytime you think a stock is going to be neutral, if you're looking at a stock, you're looking at Coca-Cola or something like that, and you think, I think this is going to be neutral. Maybe you consider an iron condor there. I will address delta here in just a sec, because I blew by that one and I meant to mention that. When we talk about delta, okay, when we talk about delta, and we said we're going to sell strikes that are around, we're going to say sell strikes that are around, the short strikes are around a 20 delta. What do I mean by that? If you look at an option chain, here's Coke as an example. There's those Greeks. You don't need to know all the Greeks, but one of those Greeks is delta. And delta tells you how much that option price is going to move in relationship to a $1 move in the stock price. Okay. Stock price goes up $1, you'd expect the option to go up about 57 cents. Okay. Stock goes down $1, you expect that option to go down about 57 cents. This is a call option, by the way. We can also use delta as a way of assessing how far in the money or how far out of the money an option trade is, and also the probability of it expiring here. So if we go to, say, a 22 delta, that tells us approximately, and that's all it is an approximation. There's about a 22% chance that this option, this is an 81 call, is going to expire in the money. For what it's worth. Anything could happen, but that's what it is, and that's why we care about it, because we want to keep the probabilities of it going in the money down. We don't want it to go in the money. Now, so anytime you feel a stock is going to be more neutral, you may consider it. You can also look at things like support and resistance levels. That's a typical way. Let's say you're looking at Pfizer here. Here's Pfizer. And let me go to a shorter term chart. And let's say you think, oh, look, I've got some support here in this level. And I think I've got some resistance kind of up in this level. And I think the stock is going to stay in between those. Maybe we would consider, investigating an iron condor on a stock like Pfizer, because we've looked at the support level and the resistance level, because that may help you to determine that's going to be in a channel, it's going to be more neutral. You can do a scan for them, okay? You can run a scan. I have a scan that sometimes I'll use. Let me show you it. Load scan query. I'm going to go to my personal scans. And this scan, by the way, is shared I'll share it with the chat here, everybody. And if you're watching on a recording, it's in the description of this webcast. Neutral option scan. Let me just scan that. We'll let it think here for a sec. But I'm going to put that in the chat. And here's the scan. And if you want, and just remember that link to the scan that you'll see either in the description of the webcast or in the chat. It's not like a URL you just click on. You need to go up here, click on Open Shared Item, and paste it right in there. Then you can click on Preview. I think it'll give you a chance to name it, and then you can click on Import. Okay. Let me just run this scan here. Okay, there we go. I just changed that. Eddie says earnings important. Yeah, earnings are possibly a consideration. Now, going back to what I said about volatility earlier, if earnings is coming up, implied volatilities are probably higher and you're going to be compensated more for the risk. That's a good thing. Having said that, a lot of traders like to avoid earnings. One part of this scan you will notice here is one of the parameters on this scan is it doesn't have earnings anytime in the next 20 bars. And that means basically those are trading days. So that's basically a calendar month. So that's avoiding earnings. And it came up with a few stocks, Cisco, Oracle, and Walmart. Now, here's the thing. You may decide you like the results. Maybe you don't like the results, but you can always look at these as a fishing ground, so to speak, of where to look. So Walmart won't have earnings in the near term. You're not going to see many financial bank stocks right now coming up on that scan because there's a lot of financial bank stocks that have earnings coming up next week. But here's kind of a neutralish scan without any earnings in the near future. in the next 20 trading days there. So that's another way of doing it. You can also do whatever strategies or things you want to do. If you're a volume profile person, a lot of people like volume profile as a means of looking at potential trades, and you're looking at a stock, and this tells you the volume profile, which you can always add by going to the studies here at the top of the page, tells you where most of the trading has taken place. And the theory on this is this. Where most of the trading has occurred, the theory is more trading is likely to occur. Well, where has most of the trading occurred, at least over the last 6 months, on Meta? Well, it's occurred where this blue kind of sideways pyramid is. So if I'm going to trade neutral, I can say, well, maybe using this parameter, maybe we think it's more likely to stay in this range here. That's more of a neutral trade. Okay, that's more of a neutral trade than something that's less than bullish or bearish. Okay, so you can do that. That's a volume profile. A lot of traders like to use that. It's not, a guarantee it's going to stay in that area. Let's look at Alphabet. Here's another company. Where's most of the trading been over the last 6 months at least? It's been kind of in this range. Stocks right here. You may consider more of a neutral type trade if that were the case there. Let me do one more. Here's Micron. Micron, kind of the same deal. Now, if it were to slip out of this range, a lot of traders may view this and say, well, if it breaks out of this range, kind of our neutral range, then it's likely to, if it were to go down here, it may, stay here for a little bit. That's how you would interpret that volume profile tool. You can decide to use that. You can decide to use whatever you want. So there's like 4 different ways. You can whatever. Anytime you think a stock is going to be more neutral, you may consider that. Now, when you're doing these trades and you want to, and I'm going to go, let's just look at Meta here. This is a company everybody knows. This is the parent company of Facebook and Instagram. It's a more expensive stock, right? I mean, it's a $650 stock. But if we're doing options, doing an iron condor, I'm going to click on the trade tab, and you have different expiration dates here. Okay? Here's your expiration dates. Remember I said earlier, we're looking kind of, in this webcast, we're going to look kind of between 20 and 50 days. I'm going to go out just 21 days here on this. Let's go out 21 days. And we got strikes, and here we go. And I have a delta column. Okay, remember that kind of gives me the probability of it being in the money. And I'm going to look for my 20 delta. It may not be exact. Well, we do have an exactly 20 delta. Often it's not. We just take the closest if it's not. But we have a 20 delta here. And I'm going to look at that bid price and ask price and just see that they're not, too far apart from one another. I probably don't want them to be 10% or more apart from one another. This is so a 650 option, 10% would be about 65 cents. Here, they're fairly tight. Just a heads up, very often those weekly options, they say weekly next to them, have less liquidity than the monthly options, okay? The ones that don't have weeklies next to them. It's not a guarantee, but that's just kind of how it works out sometimes. So I'm going to go to that 20 delta. Now, there's different ways on this Thinkorswim desktop software to load up a trade. One way is to go up to where it says spread and go to Iron Condor. But first, we got to figure out what strikes we're going to do. So I'm going to look here. I'm going to go to my 20 delta, which is switched to 19. And that's a 685 call. I'm just going to jot that down real quick. That's going to be my short call. And I'm going to go out. I'll do a $10 wide contract here. So I'm going to go to 685 and 695 on the call side. And then what am I going to do on the put side? I'm going to go to my delta. There'll be a little negative sign in front of the delta, but I'm going to do the same thing. I'm going to look for my 20 delta. It'll go to 21 delta. 575 put, and I'll go $10 wide. I'll go to the 565 put. So I'm going to sell the 575 put. I'm going to buy the 565 put. On the call side, I was going to sell the 685 call, and I'm going to buy the 690 call. And if I want to, I can go up to single and click on Iron Condor and do it. It's going to give me this. And to be very honest, usually I don't do it this way. But if you do, you just click on the bid price, it'll bring it up, and then you can just tweak those prices as they are there. Okay. Now, all right. Barbara says, why $10 wide? Because it's such an expensive stock with such expensive strike prices. If it were a $50 stock, I wouldn't be going anything like $10 wide. Okay. But this is a very expensive stock. So I'm just going to spread them out a little wider than I normally would on this. All right. And it's 2 strikes wide. So let me go back to single here. Go back to single. It's not a right or wrong thing. You can do 5 strikes wide. In fact, I encourage you to play along at home in paper money and do it and see the differences there. 10 strikes wide is going to mean I'm going to get if you keep the short strikes the same, going out wider, what's the implication of that? It means I'm going to bring in a bigger premium for it. There's more risk, though, if it goes completely against us. So it's really going to be how much risk you want to take versus the premium you want to bring in there on that. So you can do either one there. You can go even wider if you want. If you go even wider, you'll bring in even more premium. Your max risk is going to be even more here. Now, here's the other way to enter the trade. You go to the strike you want to sell, and you click on the bid price. Okay, that's my call. You go to the strike you want to buy. You don't click on the ask price. You hold down the control key. Then you click on the ask price. That way it adds them both in instead of just overriding the first one. I'm going to go to the put I want to sell, which is the 575. 575. I'm not going to click on the bid price. I'm going to click on the control key. Then I'm going to click on the bid price so I don't overwrite. And I'm going to do the same thing on the ask price. Control click on the ask price. This is an iron condor. I put in each of these legs individually. Okay. Notice it says, it recognizes it. It says, hey, that's an iron condor. I recognize that. There we go. There's our credit. Now, if I want to see, remember, we could look at our break evens on this. Let's click on confirm and send. I think it'll tell us. 571.65 and 688 are our break evens. I'm just jotting that down so I don't forget. Let me go back and edit this. Let's look at our chart. And I'm going to get out of that volume profile here for a sec. And let me just do this. And let's just kind of mark on the chart where we're talking about our break evens. 571, which is right rough, forgive me, it's not exact. 571.65 and 688.35. So kind of, we'll say that. That's the range we need this stock to stay in. That's our break-even point at expiration. Typically, when we talk about break-even points, in fact, I'd say not just typically, almost always, unless we specify otherwise, when we talk about break-even points, we're talking about break-evens at expiration. Remember, we've got short options here that could theoretically be assigned early if we weren't in paper money. It's probably not going to be assigned if it's out of the money. It could be, theoretically. If it goes a little bit in the money and we're a little ways till expiration, it's probably not going to be assigned, but it could be. The closer you get to expiration, and the more in the money it goes on either side, the more likely that short option is going to be assigned early. Okay, that's the thing. Now, additionally, as I mentioned earlier, we're going to look to exit this trade once we get kind of maybe under 10 days to go to expiration, about a week to go to expiration. That's going to help minimize the possibility of early assignment. Here's the trade. We want it to be neutral. Do you think it's going to be neutral? I don't know, but that's what we're kind of banking on here. on this. Let's go to this. Now, let's click on confirm and send again. Here's my max profit. Here's my max loss. If this max loss isn't acceptable, then you wouldn't do that trade. This is a more expensive stock. If you come up with a cheaper stock, the numbers are probably going to all be reduced here. Okay, max profit and max loss. If on our rules that we kind of went through, our not suggested rules, but our example rules, we said 1 to 2% of your active trading portfolio. So just see if that fits in there. You can always ramp up the number of contracts if you wanted. There's 2 contracts. If I make it 2 contracts and I click on confirm and send, these numbers are just going to double right there. So, and then if I decide I want to send it, I can do so. But before I do so, let me just mention this. When you do a spread trade on the Thinkorswim platform, when you do a spread trade, it's going to default to the mid price. Realistically, unless you sit and wait, let the market move a little bit after you enter it, it's probably not going to fill. If you do enter it at the mid price, in this case 327 right now, if you do enter it at the mid price and sit and wait for it to fill, it may fill at that price. It may never fill, right? So I'm not going to do it at the mid price. No, I'm also not going to go all the way to the natural price. I'm going to just kind of go in between those to try and increase the odds of it filling and to get the trade filled, but not accept too low a price. So I'm going to go kind of in between those. I'm going to confirm and send, and then it gives me this information, and I'm going to put that, I don't have any groups set up right now, so I'm going to just click on send on that. There we got the trade, okay? And we filled. Now, what is it going to look like? Well, we're looking at Meta. Here's Meta. That's what it looks like. That's an iron condor trade right here. Expires in 21 days. And we're going to look for it. Now, how are we going to manage the trade? Once you're in the trade, how do you manage the trade? Well, this is how we're going to manage the trade. First of all, we're going to look at these as kind of 2 separate trades in a sense. Here's my put spread. Here's my call spread. If the put spread is doing great and we've made most of what we can make on the thing, then what we'll do is we'll just get out. Maybe we've made 50% on it and there's 10 days to go till expiration. We'll just close that out, okay, on that put side. Or if you've made most of what you can make, maybe even if you made 80%, definitely, I would say most traders would probably look to exit if you've made 80% of what you can make on that. Not every trader. Some traders will just hold on. Absolutely. If the put side's doing well, what does that mean? That means Meta is probably going up or staying the same, or kind of in that range. If it's staying in the range, both sides may be doing well. But very often what happens is the stock either goes up or down. If the stock goes up, the put side is probably going to be doing well. The call side is probably not going to be doing well. We're probably looking at a stop. Your instinct is probably going to say, I'm just going to cut my losses short and I'm going to get out of the call side immediately. You don't necessarily have to do that. You may, if you think it's going to just keep on going up, but very often what happens with stocks is they go up and then they pull back a little bit. In other words, when you look at a stock and it goes up, often it'll pull back, or it goes down and it pulls back up, or it jumps up and comes back down. So if this happens to jump up from here, there's a decent chance it may give you a pullback, and the pullback may give you more of an opportunity to buy back that call for either less of a loss or hopefully even a profit at that point there. Okay, so there we go. There we go on that. Okay, so let me go on this and clear that out. Question, the ATR, the average true range, is $21. Well, you can use the ATR. Average true range is just a measure of kind of an average, the average daily move, factoring in gaps as well. Okay, the average range on that chart. What was our strikes on this? Okay, remember our goal, it's not exactly our break-evens. Our break-evens are a little bit below the 575. Oh, I actually wrote them down earlier, so I don't even have to look. Break-evens were 571, 688. Well, I don't know. I'll let you guys make the judgment of if that is, here's 688 right up there. Sorry, that's not what I wanted there. Here's 688 up right about there and 571 down here. If you think that's too much, given the ATR or whatever other volatility measures you use, don't use a trade. Right now, our assumption is this: if it moves up, it's likely to come back down. If it goes down, it's likely to come back up. Remember, the rationale on that was, this is our volume profile. Expectation is if it starts to go up here, it's more likely to encounter some resistance up here. If it goes down here, it's more likely to encounter some support down there. Okay, that's the theory on that. All right, now, I was going to look at some other trades. Alas, I'm running out of time here. So I will look to manage this trade in upcoming sessions, either in this webcast or in my Managing an Options Portfolio webcast. If you're interested in the Managing an Options Portfolio, here's a playlist for that webcast, okay? Just to give you an idea of that. And remember, in terms of management, we're going to have 3 management kind of ideas in your head. It doesn't matter, this type of trade or any other kind of option trade. Have an exit, have an idea of managing it if it goes up, if it goes down, or if it goes kind of maybe sideways, and if time is running low on us. And remember, we're going to manage one side at the time. If you're getting a significant profit on one of those, just get out of that side of the trade. If time is expiring, we got a week to go to expiration, we're probably just going to get out of the whole thing. And if it's going against us on a particular side, then we'll look at it a little more closely and decide whether we think it's going to rebound at that point there. Okay. All right. So let's go, and let me just mention this. For those of you who are new, we welcome you. I encourage you to subscribe to the Trader Talks channel. That's what we're on. You can also go to schwab.com/coaching and click on on-demand webcasts. And of course, you're on YouTube right now, and you can see the different webcasts that we have there. And you can view the calendar of these. Pull up the calendar, and you can see this listed out. Hey, look, here's James. Okay, that was this morning, but you can go through, you can sort it by different coaches. If you want to find James Boyd, click on James Boyd. And then you can see, oh, it's all James Boyd. And you could go by, well, look, I want to know futures. And let me get out of that. And here's futures. Okay, so you can search for what you want on this. But it all starts with subscribing. If you subscribe, you have access. You'll see that come up on YouTube. Also, if you liked it, we encourage you to click on the thumbs up. I'd appreciate it. It helps me out, and it helps us out. It helps to promote our product. Free education, that's worth promoting, I think. Also, there is a survey link. So if you have some feedback, we'd love to hear your feedback. There's a link in the chat. James put that in the chat again. Just feel free to click on that chat. All right, everybody. Thank you for joining me. We'll be back at it same time next week. In the meantime, coming up next, we have market and sector analysis. And everybody have a wonderful weekend ahead. Bye-bye, everybody.